Hey team, how you going? I've been asked to do a bit of a video around property markets and interest rates, or inflation and interest rates, and what's going to actually happen over the next few years. So just so you're aware, inflation is quite high at the moment. So the target rate's between 2 and 3% from the RBA, and we're around 4.9% as of last month, and that's planned to go a lot higher. You've already seen the impact of that at the fuel bowser. You've got a pretty high cost of fuel. Cost of goods are increasing, supply chains have broken down, and people are trying to get back on track with linking those supply chains back together after COVID and everything that's happening. And then we've got the Ukraine, we've got obviously the Russia and everything that's coming down on Russia, so that the fuel costs are going up because we're no longer buying fuel from Russia, all those sorts of things, or oil from Russia. So all of that has come to like a perfect storm in where we are now. The rates will start to be increasing over the next few months. I think they'll start from around about June, May, June. Some others out there might think it's a little bit later, but the general consensus is they are going to start going up today. Now, there's a few components that we need to think about. There's around about, I believe, $500 billion worth of fixed rates at the moment that are due to expire in the next about 2 to 3 years. Why that's really important is that 500 billion of fixed rate. There's more than that in fixed rate, but this is 500 billion, or approximately, that are fixed below 2.5%. Okay, that means that in 2.5 years, 2 to 3 years time, when they actually come out, if the rates go up to what they're anticipating, so they're anticipating 9 interest rate increases. 9 25 basis points or approximate interest rate increases up to around about 2.25. So that would take us from a 0.1% of a low right now, which is historically low, up to a 2.25% or 225 basis point over the coming 2 to 3 years. Okay, so what that is basically for a homeowner that's fixed in at a less than 2.5% rate at the moment, is that they're basically going to be finishing their fixed rates, and they're going to have to refinance, if they want to, back onto the variable at twice the repayments or twice the interest rate of what they are now. That's going to have a dramatic impact on their hip pocket in those years. But for the people who aren't fixed in at the moment, the rising rates are going to periodically happen, and that's going to increase by about $700 a month on around about a $580,000 to $600,000 mortgage. So from what you are paying today, if that's what actually happens. Now, the reason that's really important, and the reason that a lot of people are worried, is that what we call the debt to income ratios, or debt to household income. So what happens is the debt to household income, or the Australian repayments to household income, is increasing. As you can see here on this graph, you can see here around 2022, it's starting to spike up, and that's because what's the anticipation has is that rates are going to be going up, and the total debt in terms of repayments can cost you per year is going to become a larger proportion of your household income, which is going to give you less disposable income. So that's going to have a dramatic effect on things like the property price, and that's why they think that there's going to be a plateau and even a downturn in a lot of the markets like Sydney and Melbourne. Some of the other markets, they may not have a full downturn, but if it goes up to around 2.25% increase, don't be surprised if the downturn, I think, in around about the 10-15% range, maybe up 20% range. But just like property markets, they've increased by 30 to 60% over the last few years. So a small downturn or a depression on the price market is fairly reasonable to expect. So what that means is over the next few years, we're going to have rates going up. They're going to be going up fast and furious when they do start to happen. It's going to happen this year to start with, and there's going to be subsequent rate rises. So one thing that we need to do is make sure that our affordability is sorted. So we need to make sure that we're having a look at our situation, we're budgeting, we're managing our money, and we've got a surplus in our account. So what I would recommend usually, if you've got a mortgage, is to start paying a couple of % more and putting it into your offset account or back into the mortgage, usually an offset account, so you don't change the format of the loan itself. And then that way you can make sure you can afford that amount at that higher repayment level. If you don't want to do that, that's cool. That's no stress at all. You can obviously invest that money. So what people should be looking for or looking out for is they should be planning an extra $300 to $500 every single month out of their pocket into their mortgage in the next 12 months. Take into consideration now that your mortgage is going to go up by at least $300 up to $500 in the next 12 probably to 14 months, okay, and making sure that we're actually budgeting for that. Okay, so what will happen is it's going to make refinancing a little bit harder. So make sure you're planning it now, so that if you need to refinance, you've been thinking about refinancing, you get those actioned and you get it set up. It's also going to probably decrease some of the property prices, so you're not going to be able to access your equity as easily as you once did in the pre sort of boom days. And the last thing is if I just want to draw your attention here, this gives you an anticipation of what other countries are doing as well. It's not just us. Australia is not special by any stretch of the imagination. It's a great country, but we're not special in terms of monetary policy. These are different countries, and this is all of these countries' expectations based on the rates. You can see that we're sort of in the middle to lower category, middle. I would say there's countries that are above us, there's countries that are below us, but we're sort of on that trajectory of increased price around the 2.2. So you can see most of them are pricing about 1.75 to around 2.25 to 2.3 or 230 basis points. So that means there's a really good understanding that we know that rates are going to be around that amount or close within it. Like I mentioned, if it goes to that amount, you need to basically factor in at least a $700, potentially $1,000 increase a month on your mortgage, depending on 580 to 600,000 approximately. If you're fixed in right now at sub 2.5%, when you come out of your rates in a couple of years' time, expect it to double because you're going to be paying probably close to around about the 5% because your basis points on your borrowing rate with the RBA, and then you've got your interest rates, which are real. Okay, so they're the main things that you need to consider as well. And if you've been looking at your property and you're highly leveraged, don't be surprised if your property prices are coming back into quite a substantial amount. So you need to be careful of what you're doing with your money. I think that's the most important thing. So if we're having a look at it generally, property prices are definitely stopped with the boom. They've already plateaued at the moment. Clearance rates have decreased in auctions as well. Rates are going to be going up. Inflation is on the rise. So it's going to become tighter markets across the board. Unemployment rate has dropped to historical low rates, which is good, which usually comes with rising inflation as well. So they're the things that I'll be looking out for, and that's what I think is going to be happening with the property market at the moment. So prices are going to be pretty depressed over the next couple of years. Rates are going to be increasing. So I think it's a really good time to set into a debt reduction strategy to create equity in your own home, because if your price isn't going up, the other way you can create equity is by going down. Another way to offset rising rates as well is to look at cash flow strategies, multi-units on one dwelling, getting a 10-12% return gross, maybe a 7% net. And then if your rates are still going up to 5%, you're still positive by 2%, even if you borrowed 100% using equity of another property, and use that 2% to supplement your current mortgage as it stands. So cash flow rates, cash flow strategies can really help in a rising market. And I think they're going to be becoming a lot more prominent, a lot more popular in the next few years as well. So I hope that gives you a bit of an idea about what's happening with the rates, inflation, and also property over the next couple of years in Australia.